In early 2019, a towering, charismatic entrepreneur stood at the peak of the startup world. Adam Neumann had transformed a simple idea about shared office spaces into what seemed like a revolutionary movement. WeWork, the company he co-founded in 2010, had reached an astonishing valuation of $47 billion. Investors believed they were witnessing the birth of the next tech giant. Within months, that entire empire would crumble, exposing one of the most spectacular business failures in modern history. The story began innocently enough. Neumann and his partner, Miguel McKelvey, opened their first co-working space in New York City with a straightforward concept. They would sign long-term leases on office buildings, renovate them into trendy modern workspaces, and rent them out by the desk or by the room to freelancers, startups, and small businesses. The spaces featured free coffee, craft beer on tap, ping-pong tables, and a sense of community that traditional offices lacked. For young companies and independent workers, it seemed perfect. What made WeWork different, at least in Neumann's telling, was that this wasn't just real estate. He positioned the company as a technology firm, a platform that would revolutionize how people work and live. He spoke in grand terms about elevating human consciousness and creating a new way of being. Investors, caught up in the era of rapid tech valuations, bought into the vision. Money poured in at an incredible rate. The business model itself contained a fundamental flaw that would eventually prove fatal. WeWork signed leases with landlords that typically lasted 10 to 15 years. These were fixed obligations, meaning the company had to pay rent whether spaces were full or empty. But the company offered its members flexibility, with most agreements lasting less than 2 years, and many available month to month. This created a dangerous mismatch. WeWork carried billions in long-term debt, while relying on short-term, unpredictable revenue streams. During good economic times, this arrangement worked well enough. Spaces filled quickly, and the company could charge premium rates for the convenience and community it offered. But the model had no cushion for downturns. If occupancy dropped, WeWork would still owe massive rent payments, with no way to reduce costs proportionally. The company was essentially betting that demand would never fall and that it could always charge more than it paid. Neumann pushed aggressive expansion at a breathtaking pace. The company opened hundreds of locations across the globe, burning through cash at an estimated rate of over $200,000 per hour at its peak. By 2019, WeWork had committed to more than $47 billion in lease obligations over the coming years. The company had never turned a profit, but Neumann dismissed traditional financial metrics. He invented his own measurements with names like community-adjusted earnings, which excluded many actual costs. The message to investors was clear: don't worry about losses today, focus on the future potential. Behind the scenes, troubling patterns emerged. Neumann began engaging in transactions that raised serious ethical questions. He purchased several buildings personally, then leased them back to WeWork at a profit for himself. He trademarked the word "we" and sold it to his own company for nearly $6 million in stock. The company loaned him millions, which he used to buy luxury properties, including a $60 million private jet. He sold hundreds of millions worth of his own shares while encouraging employees to hold theirs, telling them the company would only grow more valuable. The corporate governance structure gave Neumann nearly absolute power. He controlled supervoting shares that meant his votes counted far more than other investors. He had structured the company so his family could theoretically control it for generations. His wife held the title of Chief Brand Officer and reportedly fired employees based on their energy after meeting them for mere minutes. The board of directors, which should have provided oversight and challenged questionable decisions, largely rubber-stamped Neumann's plans without meaningful pushback. The culture inside WeWork reflected the founder's personality. There were reports of heavy drinking at company events, marijuana use on private flights, and lavish parties funded by corporate money. After announcing layoffs affecting 7% of staff in 2016, Neumann reportedly had workers pass around tequila shots before bringing in a rapper to perform. The disconnect between the company's precarious financial situation and the extravagant spending became impossible to ignore. In August 2019, WeWork filed paperwork with securities regulators for an initial public offering. The company planned to sell shares to the public, which would allow early investors and employees to cash out and provide fresh capital for continued expansion. The filing, known as an S-1 document, required WeWork to disclose detailed financial information for the first time. What it revealed shocked the investment community. The documents showed that WeWork had lost nearly $2 billion in the previous year alone. Revenue was growing, but losses were growing just as fast. The company's complicated corporate structure, with subsidiaries designed to shield the parent company from liability, looked suspiciously like an attempt to avoid accountability. The self-dealing transactions came to light, including the buildings Neumann owned that WeWork rented, and the trademark payment. The supervoting shares and governance provisions seemed designed to prevent anyone from questioning the founders' decisions. Public market investors, unlike the private venture capitalists who had funded WeWork's growth, applied traditional real estate metrics to analyze the company. What they found was troubling. This was essentially a real estate subleasing business, not a technology company. The technology components, like a mobile app and data analytics, represented a tiny fraction of operations. 95% of revenue came from simply renting office space, yet the company had been valued like a high-growth tech startup with unlimited potential. The reaction was swift and brutal. Investment banks that were managing the offering began slashing their valuation estimates. Numbers that had started at $47 billion dropped to $30 billion, then $20 billion, then as low as $10 billion. Major investors openly questioned whether the company should go public at all. News reports detailed Neumann's eccentric behavior, questionable spending, and conflicts of interest. Employees who had taken pay cuts for stock options watched in horror as their equity evaporated. On September 24, 2019, Neumann stepped down as chief executive. The company announced it would delay the public offering indefinitely. Just 6 weeks after filing to go public, WeWork pulled the entire plan. The valuation had collapsed from $47 billion to under $8 billion in a matter of weeks. Thousands of employees would soon lose their jobs. SoftBank, the Japanese conglomerate that had invested over $10 billion in WeWork and pushed the company toward its inflated valuation, faced a crisis. The firm had to choose between accepting massive losses or pouring in more money to try to salvage the situation. It chose the latter, effectively taking control of the company through a bailout package. Neumann walked away with a severance package initially reported at $1.7 billion, though this was later reduced. The deal included payments for his shares, consulting fees, and help repaying personal loans. The aftermath was devastating for many stakeholders. Employees lost jobs and saw their stock options become worthless. Landlords who had signed deals with WeWork suddenly found themselves negotiating with a company in crisis. Investors who had believed in the vision suffered enormous losses. The company eventually went public in 2200 through a different mechanism at a fraction of its former value, and filed for bankruptcy in 2003. The WeWork collapse became a case study in corporate governance failure. A charismatic founder with unchecked power, a weak board unwilling to challenge bad decisions, a fundamentally flawed business model, and investors who prioritized growth over sustainability all combined to create disaster. The story illustrated the dangers of valuing companies based on potential rather than fundamentals, of allowing founders total control without accountability, and of confusing vision with viable business strategy. In the end, what started as a promising idea about modernizing office space became a cautionary tale about ego, excess, and the perils of believing one's own mythology. Adam Neumann had built something real, but his inability to balance ambition with sound business principles, combined with a system that enabled his worst impulses, turned a $47 billion company into one of the most dramatic collapses in startup history. The elevating consciousness he promised became instead a stark reminder that even the most compelling vision requires solid foundations to survive.